Okay, so for this next part, when we're talking about a company that has an accounts receivable, uh, sometimes they can't pay their bills, and they've been may have been in business for a very long time. They deal with a company, and they call the company and say, "Hi, my name is such and such, and I'm with this company. We've dealt with you for 15 years, and we can't pay our bills. Are you willing to change our accounts payable to a notes payable and take the payment later with some interest?" Well, if it's a good company and they've worked with them for a lot of years, the company is likely to say yes. Well, we're going to deal with a couple different slides. The first one is 14-6, and the second one is 14-10. So, 14-6 looks just like this, and it actually says, "Note from a charged customer to extend time on account. On April 6th, Green River Rafts sent Whitewater Raft Supply a note for $930 payable within 30 days at 6% interest in settlement of the transaction of March 7th. Okay, so they had a transaction on March 7th where they made a sale. They made that sale and expected accounts receivable, but the company couldn't pay it. Okay, no problem. They're willing to work with them. They say, not a problem. We'll give you the extra time, but we're going to ask for 6% interest for that 30 days. Well, 6% is actually annual rate, as you know. So it's going to be the principal of 930 times 6% or 0.06 times 30/360th, like we learned in the last chapter. Okay, so in exercise 14-10 or slide 14-10 in exercise practice exercise 1B, we have a situation where they've received the payment at maturity of the principal of $960. Interest on Singer and Moore Incorporated's note from practice exercise 1A. Now, you can look up in your book and you can take a look and see what is 1A talking about. So I suggest you open your book, look at 1A, come back and hit pause, and then come back and go ahead and look at the slide, look at more of this video. Okay, so when you do this, we're going to see they expect to receive cash. The company that made the sale expects to receive cash. They weren't able to receive accounts receivable, so they're giving them an extra 30 days. Okay. So if you look at slide 14-10, the very bottom, the very last line, it actually says 960 times 0.08. Well, we know they charged 8% interest times 30/360th. Okay. What does that come to? Well, pretty easy if we just look over to the right-hand side and we see the interest income came to $6.40. $6.40 plus the notes receivable comes to a total of the cash that will be received. So they're going to receive the principal and they're going to receive the interest for $966.40, and then they debit